So in a venture scale company, anti-dilution protection is something that applies to the investor's class of stock, which is preferred stock. And the way that it works mechanically is that there's a conversion ratio starting out when you purchase preferred stock. The conversion ratio is 1-to-1 with common stock. So you have one share of common preferred stock, and you can convert that to one share of common stock at some point in time where it's beneficial to actually have common stock rather than preferred stock. So that conversion ratio of 1-to-1 stays the same as long as the company is growing in value. What happens is if the company then shrinks in value, either naturally or because somebody is engineering some sort of dilutive financing that's unfair to investors, that conversion ratio is going to change. And instead of having a conversion ratio of 1-to-1, it's going to be 1 to something more than 1. So the preferred stock then will convert to more than one share of common stock for each share that they have. So I think a lot of times people are curious, well, why would investors get more stock than they initially purchased, whereas founders don't? And I think that's a good question, and I think one way that we can look at this conceptually is that the value that founders bring to the table is hard to quantify. Basically the tax value of their stock is nominal typically at the beginning. And so, the actual value that they have really is, whatever their proportional ownership is at exit time. If the company goes up in value, if the company goes down in value, there's some corresponding value that you could attribute to the founder's stock, but they haven't really done anything different, from point A to point B where the value of where the value of their ownership is different. On the other hand, investors are bringing in a very finite amount of money. They, may purchase their stock for, $3 million. And they have $3 million in value at that point in time. Now, if the company fluctuates afterwards, then there's a very clear distinction between the amount of value that they have versus the amount of value that they put in at the beginning. If it appreciates, then they're doing well. If it depreciates, then they're not doing so well. Now, obviously, that's a component of the risk that you take when you invest in these kinds of companies. But at the same time, they do want there to be some sort of disincentive against the company shrinking in value, against the company deciding to go raise money at a lower valuation, or anything that basically dilutes them, under terms that are less favorable to them than the previous investment round that they got involved in.